The greatest financial mistake you can make in retirement isn't losing money. It's believing that safety means holding cash, while inflation slowly erases everything you spent a lifetime building. Warren Buffett understood this long before most investors even knew what inflation really meant. Not the academic definition, not the percentage printed in newspapers, but the quiet, relentless way it reduces purchasing power year after year until what once felt secure becomes inadequate. He recognized that the enemy wasn't volatility or market crashes. It was the invisible tax that never sleeps, never negotiates, and never stops compounding against you. This is not investment advice. I am not a financial advisor. What follows is an exploration of philosophy, not a prescription for action. The ideas presented here are meant to provoke thought, not dictate decisions. Always consult a qualified professional before making financial choices. But here's the question worth asking. After 40 years of earning, saving, and sacrificing, how do you protect what you've built from the one force that respects neither effort nor intention? Warren Buffett spent 8 decades answering that question, not with complexity, not with sophisticated strategies or exotic instruments, but with 3 simple asset classes that share one defining characteristic. They produce value independent of what happens to paper currency. They survive inflation not by outrunning it, but by transcending it entirely. Let's begin with what inflation actually does to retirees. By the time you're 65, you've likely accumulated more wealth than at any other point in your life. Your mortgage is paid or nearly paid. Your expenses have settled. Your income, whether from Social Security, pensions, or savings, feels predictable. For the first time in decades, you might feel something close to financial peace. And that's precisely when inflation becomes most dangerous. Because peace creates complacency. Complacency creates cash positions. And cash positions create the illusion of safety while guaranteeing erosion. At 3% inflation, your purchasing power is cut in half every 24 years. At 5%, it's 12 years. If you retire at 65 and live to 85, even modest inflation will devastate a portfolio built on safety alone. Buffett saw this early. Growing up during the Depression, watching his father navigate economic chaos, he absorbed a truth that shaped his entire investment philosophy. Nominal safety is not real safety. A dollar that sits still is a dollar that dies slowly. The only true protection is ownership of assets that generate value faster than currency degrades. This wasn't theoretical for him, it was survival. In 1945, when Buffett started his investment partnership, inflation was low, but memories of its violence were fresh. He'd watched families lose everything, not because they spent recklessly, but because they saved in the wrong vessels. They put faith in bonds that paid fixed coupons while prices doubled. They trusted banks that offered interest rates lower than the cost of living. They confused liquidity with security and paid for it across decades. So Buffett built his career around 3 asset types that couldn't be inflated away. He didn't chase performance. He didn't speculate on trends. He simply acquired things that produced value regardless of what the Federal Reserve did with money supply. And in doing so, he protected not just his wealth, but his freedom. The first asset class is businesses, not stocks, not tickers, not abstractions traded on screens, businesses, real enterprises with customers, products, competitive advantages, and the ability to raise prices when costs rise. This distinction matters more than almost anything else in investing. When you own a share of stock, you're not buying a number that bounces around. You're buying a fractional claim on a productive enterprise. If that enterprise makes something people need, and if it has the power to charge more when input costs increase, then inflation doesn't destroy your wealth. It transfers wealth to you. Buffett explained this repeatedly, though few truly listened. He said that the best protection against inflation was owning a business with two characteristics: minimal capital requirements and the ability to pass along cost increases to customers. Translation: businesses that don't need constant reinvestment just to maintain themselves, and businesses whose products or services are so essential that customers pay whatever the price becomes. Think of See's Candies, which Buffett acquired in 1972. It required almost no capital to operate. The machinery was simple, the recipes were stable, the brand was strong. Every year, when sugar prices rose or labor costs increased, See's raised its prices. Customers grumbled, but paid. The business survived inflation not by fighting it, but by existing in a category where loyalty exceeded price sensitivity. This is what retirees need to understand. The right businesses are not just assets. They are inflation-fighting machines. They adjust automatically. They compound value even when currency loses it, and they do so without requiring your intervention, expertise, or stress. But most retirees don't think this way. They think owning stocks is risky. They think volatility equals danger. They sell during downturns and sit in cash, congratulating themselves on avoiding losses, never realizing they've locked in the one guaranteed loss inflation delivers. Buffett's advice was brutally simple: own pieces of excellent businesses and do nothing. Let them raise prices. Let them compound earnings. Let them adapt to changing costs. Your job is to stay out of the way. The mistake retirees make is confusing short-term price volatility with long-term value destruction. If you own a great business and its stock price drops 30% in a recession, you haven't lost anything unless you sell. The business still operates. It still serves customers. It still generates cash. The price is just noise. But if you sit in cash earning 1% while inflation runs 4%, you lose 3% every year with mathematical certainty. That's not volatility. That's erosion. And erosion is permanent. Here's the truth that sounds harsh, but sets you free. By the time you're 60, the margin for error is gone. You can't afford to play it safe with assets that guarantee loss. You need assets that survive reality. Buffett's second inflation-resistant asset is land. But not just any land. Productive land. Farmland specifically. Land that grows crops, generates income, and appreciates independent of currency fluctuations. Buffett bought his first farm in 1986, a 400-acre property in Nebraska. He knew nothing about farming. He hired someone to run it. But he understood the fundamental principle. Farmland produces food, and food demand is inelastic. People need to eat regardless of what money does. As long as the land is well managed and reasonably priced, it generates income that rises with inflation. This is the key insight retirees miss about real assets. They think real estate or land is speculative. They think it's for young people chasing appreciation. But productive real assets aren't speculative. They're functional. They produce something valuable. And when inflation makes everything more expensive, the output of those assets becomes more valuable too. Farmland doesn't care what the dollar is worth. It produces corn, soybeans, wheat, whatever the tenant plants. If corn prices double because of inflation, the farm's revenue doubles. If farmland becomes more expensive to buy, your existing holdings become more valuable. You're not hoping for appreciation. You're harvesting it automatically. Buffett liked to contrast this with gold, which he famously disdained. Gold produces nothing. It sits in a vault, shiny and inert. If you buy an ounce today and hold it for 20 years, you still have 1 ounce. It generates no income. It requires storage. It pays no dividends. The only way you profit is if someone else pays more for it later, and that person's only hope is finding someone willing to pay even more. But farmland feeds people. Every year, it produces crops worth selling. Even if prices stagnate, you collect rent or revenue. The asset works for you. It doesn't just sit there reflecting fear. Retirees should think about this distinction carefully. Much of what passes for inflation protection is really just speculation dressed in fearful clothing. People buy gold coins, hoard silver, accumulate commodities, thinking they're hedging against disaster, but none of those things produce value. They're just transfers of wealth between frightened parties. Productive real assets are different. They generate income in good times and bad. They adapt to inflation by raising what they charge for output. They compound over decades without requiring your attention. And they do all of this while giving you something tangible to pass along when you're gone. Buffett didn't buy farmland because he loved agriculture. He bought it because he loved assets that couldn't be printed, couldn't be debased, and couldn't be politicized out of existence. Land is finite. Demand for food is infinite. That imbalance is the safest bet in economics. Now, most retirees can't buy a farm. They don't have the capital, the expertise, or the desire to manage tenants and crops. But the principle applies to whatever productive real assets they can access. A rental property that generates income. A piece of commercial real estate held in a fund. Even timber or water rights if available. The form matters less than the function. Own something that produces value independent of currency. Buffett's third asset class is the most misunderstood and, for retirees, possibly the most important. Your own skills. He said this plainly. The best asset you can own is yourself. Whatever you can do, whatever you can create, whatever value you can deliver to others, that ability survives inflation perfectly. It adjusts automatically. If you're a surgeon and costs rise, your fees rise. If you're a consultant and money loses value, your rates increase. If you have knowledge, relationships, or expertise that others need, inflation makes your services more expensive in nominal terms, but equally valuable in real terms. This sounds abstract until you realize how many retirees destroy their financial security by retiring too early or too completely. They stop generating income at 62, expecting Social Security and savings to carry them through 30 more years. Then, inflation hits. Their fixed income shrinks in real terms. Their savings erode, and they have no mechanism to adapt because they've shut down their greatest asset, their ability to produce value. Buffett himself is the ultimate proof of this principle. He's in his 90s, still running Berkshire Hathaway, still compounding wealth, still generating value through his expertise and reputation. He doesn't need to work. He works because his skills are the one asset that compounds without limit and adjusts to any economic environment. For retirees, this doesn't mean working forever at a job you hate. It means staying economically relevant in some form. Teaching, consulting, advising, creating, mentoring, doing something that keeps your skills sharp and your income flowing, because The moment you stop being able to generate value, you're entirely dependent on assets that may or may not keep pace with inflation. And that dependence is terrifying. Here's the practical truth. If you're 65 and healthy, you likely have 20 more productive years available. Maybe not full-time, maybe not high stress, but productive. And those years are the ultimate inflation hedge because your ability to earn adjusts instantly to whatever the economy does. Your skills can't be diluted. Your knowledge can't be printed into worthlessness. Your relationships and reputation compound without external interference. Buffett lived this philosophy completely. He accumulated businesses and farmland and market positions, yes, but his real wealth came from being Warren Buffett, from having a reputation that opened doors, a mind that synthesized complexity, and a discipline that outlasted competitors. Those weren't assets on a balance sheet. They were inflation-proof engines of compounding value. Retirees who understand this stay engaged. They don't retire into passivity. They retire into purpose, using their accumulated knowledge to generate income in low-stress, high-value ways. And in doing so, they protect themselves from the one risk that static assets can't fully address, the risk that inflation runs hotter and longer than expected. Now, let's confront the emotional core of all this. Why do retirees resist these ideas? Why do they cling to cash and bonds and fixed income products that guarantee erosion? Why do they distrust the very assets that protect them? Fear. Not fear of loss, though that's part of it. Fear of complexity, fear of appearing foolish, fear of making a mistake late in life when recovery is impossible, fear of admitting that the safe path they've followed for decades might be the most dangerous path of all. Buffett understood this fear intimately. He saw it in his father, a stockbroker and congressman who lived through the Depression and never fully trusted the markets again despite making a career in them. He saw it in clients who preferred guaranteed mediocrity to uncertain excellence. He saw it in himself during moments when the market turned vicious and every instinct screamed to sell. But he also understood that fear, left unchecked, becomes the greatest destroyer of wealth. Because fear makes you conservative when you need to be rational. It makes you hoard cash when you need to own assets. It makes you value the illusion of safety over the reality of protection. The emotional challenge of retirement is this. You've spent 40 years accumulating. You've trained yourself to save, to be cautious, to avoid mistakes. And now, suddenly, the rules reverse. Safety becomes risk. Caution becomes danger. The very instincts that built your wealth can destroy it if you're not careful. Buffett's genius was recognizing this emotional trap and building a system that bypassed it entirely. He didn't try to overcome fear with courage. He overcame fear with structure. He bought businesses so good that he didn't need to check their prices. He acquired assets so productive that he didn't need to worry about currency. He invested in his own abilities so continuously that external chaos became irrelevant. This is the model retirees need, not bravery, but design, not speculation, but systems that function regardless of emotion. If you own shares in a business that sells toothpaste and the world descends into inflation, people still brush their teeth. The business raises prices. Your dividends increase. Your wealth adjusts. You do nothing. The asset protects you automatically. If you own farmland and inflation spikes, food prices rise, your rental income rises, your land value rises, you do nothing. The asset adapts without your intervention. If you maintain skills that deliver value and costs increase across the economy, Your fees increase proportionally. You adjust your rates. The market pays. Your income survives. This is what retirees crave but rarely achieve: financial peace that doesn't require constant vigilance, systems that protect you while you sleep, assets that compound while you live your life. Buffett built this for himself and then spent decades explaining it to others. Most didn't listen. They chased returns instead of durability. They confused activity with progress. They optimized for the wrong variables and paid for it across market cycles. But some did listen. Some understood that survival beats brilliance. Some built portfolios not for maximum return, but for maximum peace. And those people slept well through inflation scares, recessions, crashes, and panics because they owned assets that functioned independent of headlines. There's a story Buffett tells about his farmland. Years after buying it, he realized he couldn't recall the price he'd paid. Not because he didn't care about value, but because the asset produced so consistently that the entry price became irrelevant over time. The farm generated crops. The tenant paid rent. The land appreciated slowly, and none of it required his attention. That's the goal for retirees: not to monitor portfolios daily, not to optimize every basis point, but to own assets so fundamentally sound that you forget about them and they still protect you. Most retirees do the opposite. They obsess over bond yields and CD rates and money market returns, squeezing out tiny advantages while inflation devours their base. They watch financial news and panic during downturns and congratulate themselves on avoiding volatility, never calculating the opportunity cost of their caution. Buffett would say this plainly: you're optimizing for the wrong metric. The goal isn't avoiding volatility. The goal is preserving purchasing power across decades, and those two goals often conflict. Let's get practical. If you're a retiree or near retiree, how do you apply these principles without upending your life? First, audit what you own. Not for performance, for function. Does this asset produce income? Does it adjust to inflation? Does it compound value independent of currency? If the answer is no to all three, you're holding a liability disguised as an asset. Cash is a liability in inflationary environments. It loses value by design. You need some for liquidity. But holding years' worth of expenses in cash guarantees erosion. Buffett kept minimal cash. He wanted every dollar working, producing, compounding. So should you. Bonds are tricky. Long-term bonds get destroyed by inflation. Short-term bonds barely keep pace. Inflation-protected securities help but aren't enough on their own. Bonds have a place in a portfolio, but that place is smaller than most retirees assume. Safety is not the same as preservation. Stocks, specifically shares of excellent businesses, are the primary inflation hedge for most retirees. Not speculative growth stocks, not meme stocks, not companies burning cash and promising future profits, but boring, durable businesses that sell products people need and have pricing power: consumer goods, utilities, healthcare, food, energy, the essentials. Buffett's portfolio reflected this bias completely. He owned Coca-Cola, which sells sugary water at whatever price the market will bear. He owned American Express, which charges fees regardless of economic conditions. He owned railroads, which move goods, whether inflation is 2% or 10%. He owned insurance companies, which collect premiums, invest the float, and adjust pricing annually. These weren't exciting investments. They were functional ones. They worked during inflation, deflation, recession, and boom. They required no genius to understand and no vigilance to maintain. For retirees, this means building a portfolio of businesses so essential that their survival is almost guaranteed. You're not betting on growth. You're betting on continuity. And continuity over decades delivers compounding that speculation rarely matches. Second, consider productive real assets within your means. You likely can't buy a farm, but you might own your home outright, which is a real asset that provides housing value independent of currency. You might invest in a real estate fund that owns apartments or commercial property. You might buy into a timber fund or an infrastructure fund or any vehicle that owns tangible assets producing real income. The key is productivity. Owning a vacant lot does nothing. It costs property taxes and produces zero income. That's speculation, not investment. But owning a rental property, even through a fund, generates cash flow that adjusts with inflation. That's functional. Third, stay engaged. Keep your skills alive. Teach a course, write a book, consult part-time, serve on a board. Do something that keeps you economically relevant because your ability to produce value is the ultimate inflation protection. It adjusts instantly and compounds forever. Buffett never stopped working because work, for him, wasn't labor. It was the exercise of skills he'd spent a lifetime developing. And those skills made him more valuable at 90 than most people are at 30. You don't need to be Buffett, but you do need to be someone who can generate value when necessary. Because the retirees who suffer most during inflation are those who become entirely passive, entirely dependent on fixed income that shrinks year by year until it's inadequate. Let's talk about what this isn't. This is not a call to abandon safety. It's a redefinition of what safety means. Safety is not the absence of volatility. Safety is the preservation of purchasing power over the time frame you need it. If you're 70 and expect to live to 90, your time frame is 20 years. 20 years of inflation at 3% will cut your purchasing power by 45%. That's not safe. That's catastrophic. But owning a diversified portfolio of excellent businesses might drop 30% in value during a recession. That feels terrifying. It triggers panic. But if those businesses recover and continue compounding, you end 20 years later with far more purchasing power than you started with. That's actual safety. The emotional challenge is enduring short-term volatility for long-term preservation. And most retirees fail that challenge because they're wired to avoid pain now, even at the cost of disaster later. Buffett's greatest skill wasn't picking stocks. It was enduring. He sat through crashes, recessions, bubbles bursting, and market panics without selling. He didn't watch prices daily. He didn't obsess over volatility. He owned businesses he understood, believed in their long-term value, and ignored everything else. Retirees need that same discipline, not to be reckless, not to chase risk, but to own assets that survive inflation and then leave them alone. Let them compound. Let them adjust. Let them protect you without your interference. This requires a fundamental shift in mindset. You're not managing a portfolio for maximum return. You're building a fortress against erosion. And fortresses are built with boring, durable materials, not exotic innovations. There's a deeper truth here about aging and money. By the time you reach 60 or 70, you've accumulated more than wealth. You've accumulated perspective. You know what matters. You know what's fleeting. You've seen markets rise and fall and rise again. You've watched friends make fortunes and lose them. You've experienced enough economic cycles to recognize patterns. And yet, despite all this experience, the fear doesn't disappear. It intensifies. Because now the stakes are higher. Now there's no time to recover from mistakes. Now every decision feels final. Buffett would say this is precisely when you need philosophy more than strategy. You need principles that guide you when emotion overwhelms logic. You need rules that function when fear clouds judgment. His principles were absurdly simple. Buy businesses you understand. Pay fair prices. Hold forever. Ignore noise. Stay rational when others panic. Compound patiently. These aren't sophisticated. They're not innovative. They're not even difficult to grasp. But they're almost impossible to follow consistently because they require something most people lack: the willingness to be boring. Retirees who thrive financially are boring. They own boring businesses. They make boring decisions. They avoid exciting opportunities. They compound slowly. They don't have stories about the stock that tripled. They have decades of steady returns that preserved purchasing power and grew wealth modestly. That's not glamorous. It won't impress anyone at dinner parties, but it works. And working is all that matters. Buffett spent 80 years proving this. He avoided technology bubbles. He skipped crypto. He ignored gold rushes and meme stocks and every other mania that promised riches. He stuck to businesses he understood, assets that produced value, and patience that outlasted cycles. And he became the most successful investor in history, not by being brilliant, but by being disciplined. Not by taking bold risks, but by avoiding stupid ones. Not by chasing performance, but by protecting capital. This is the model for retirees. Be boring, be patient, be protected. Let's return to the original question. What survives inflation? Businesses that produce essential goods and have pricing power. Land that generates food and adapts to costs. Skills that deliver value and adjust to markets. These three asset classes share one trait. They produce real value independent of nominal currency. They're not bets on money becoming more valuable. They're bets on productive capacity continuing, regardless of what central banks do. Retirees who build portfolios around these assets don't need to predict inflation. They don't need to time markets. They don't need to be smart or lucky or connected. They just need to own things that work and leave them alone. This is the ultimate financial peace. Assets that protect you without requiring your vigilance. Systems that function while you live your life. Wealth that compounds while you focus on what actually matters. Because here's the final truth Buffett understood: money is not the goal. Peace is the goal. Security is the goal. Freedom is the goal. Money is just the tool that delivers those things, and only if you use it correctly. Most retirees do the opposite. They accumulate money and then protect it so carefully that it erodes beneath them. They confuse vigilance with wisdom. They optimize for safety and achieve erosion. They spend their final decades stressed about assets that were supposed to deliver peace. Buffett offers a different path. Own productive assets. Let them compound. Stay engaged enough to generate income if needed. And then relax. Trust the system you've built. Trust the businesses you own. Trust your own abilities. This doesn't mean ignoring reality. It means structuring your assets so reality works for you instead of against you. It means choosing durability over excitement. It means accepting short-term volatility in exchange for long-term preservation. And above all, it means recognizing that the greatest risk in retirement isn't market crashes or volatility or even mistakes. The greatest risk is inaction born of fear. The risk of doing nothing while inflation slowly, relentlessly, permanently destroys what you spent a lifetime building. Survival isn't about avoiding all risk. It's about choosing the right risks and enduring them with patience. It's about owning assets that adapt instead of assets that freeze. It's about staying engaged with life and economy and value creation instead of retreating into passivity disguised as prudence. Buffett proved this across 8 decades. He's still proving it now. And the lesson is available to anyone willing to accept it. Simplicity wins, discipline compounds, and productive assets survive everything. The work you did for 40 years built your wealth. The next 40 years belong to your wealth working for you. Make sure it's working in assets that can't be inflated away, diluted by policy, or eroded by fear. That's not financial advice. That's financial philosophy. And philosophy, unlike prices, doesn't change with headlines. You've worked too long, sacrificed too much, and come too far to let inflation steal what's yours. Buffett understood that. He structured his life around protecting purchasing power, not nominal wealth. He built systems that functioned across cycles. He owned assets that produced value regardless of economic chaos. You can do the same. Not by being brilliant, not by taking huge risks, but by being boring, patient, and disciplined. Own businesses that serve essential needs. Own land that produces food. Own your skills and keep them sharp. And then live your life. Travel, spend time with family, pursue hobbies. Do the things you deferred for decades while building your career. Because the point of financial security isn't to watch portfolios grow. It's to stop watching portfolios entirely. It's to build a system so durable that you forget about money and focus on meaning. That's what Buffett achieved. Not maximum wealth, maximum peace. The freedom to focus on what he loved, knowing his assets would protect him regardless of what happened to currencies, markets, or economies. You deserve the same. You've earned it through years of discipline and sacrifice. Now honor that effort by protecting it correctly, not with fear, not with caution, but with assets that produce value, compound patiently, and survive whatever comes next. The years ahead will bring challenges. Inflation will rise and fall. Markets will panic and recover. Policies will change. Crises will emerge. But if you own the right assets and leave them alone, none of that will matter. You'll be protected. You'll compound. You'll sleep peacefully, knowing that your wealth is working while you rest. That's the gift Buffett gave the world, not a formula for riches, but a framework for peace. And peace, in the end, is what every retiree actually wants. May your final decades be marked not by stress over money, but by gratitude for a system that works. May you spend your days focused on life, not portfolios. And may the assets you own protect you so quietly, so effectively, that you forget they're even there. That's retirement done right. That's financial wisdom. That's the legacy Warren Buffett leaves for those willing to learn. Not excitement, not complexity, not promises of wealth, just simplicity, discipline, and assets that survive.